The Deep Dive is back, and you are listening to Talk Tickers, the segment designed to give you the playbook straight from the earnings call.
Hey there!
Today, we're tearing apart the fiscal Q3 2025 results for BJ's Wholesale Holdings, Inc. They dropped pre-market on November 21st.
And this was a classic high-tension report. I mean, on the surface, you see this solid earnings beat. It really demonstrates an ironclad control over their profitability.
But just beneath that headline.
Exactly. Beneath that, you see these persistent questions about, sales volume and competitive top-line growth.
Right. And the market felt that tension all day long. The stock, it finished modestly higher, up about 1.1%, but it was just a roller coaster ride of volatility.
Yeah.
And that tells you investors are rewarding the stability, sure, but they're still holding some serious reservations about how BJ's actually competes for share of wallet.
Which brings us to our mission today.
Our mission is to dive into that specific conflict. What is the secret engine that's funding this profit success, and why that's that sales growth bottleneck continuing?
Okay, let's start with the numbers, the essentials that drove that reaction. BJ's delivered adjusted earnings per share of $1.16.
That's a clear beat.
A clear victory, yeah. It beat the street consensus, which was sitting between, $1.09 and $1.10 by a pretty significant 6 to 7%. That is a powerful signal on cost discipline.
Strong profitability right out the gate.
Yes, but the sales figure was much softer. Total revenues came in at $5.35 billion.
This was pretty much in line with what people were expecting.
It's essentially right on target, up 4.9% year over year. The disappointment, the thing that really created the volatility, was the comparable club sales, excluding gasoline. That key metric only increased 1.8%.
And that 1.8% is the number that immediately raises eyebrows, especially when you put it in context.
Of course.
It fell short of the fact set expectation of roughly 2.4%, and maybe more critically, it keeps BJ's performance lagging behind its key competitors. I mean, many of them have recently reported mid-single-digit comparable trends.
Precisely. And so management has to deal with that comparison. CEO Bob Eddy, he addressed this by focusing on BJ's core identity.
The value destination.
Value destination in a volatile environment. He didn't dwell on the comp number itself, but instead he highlighted the foundational strengths. Resilient traffic, which they proudly noted was their 15th consecutive quarter of growth, and just stellar membership economics.
So the narrative is, if the economy gets rough, our model provides protection.
That's the narrative.
Okay, so let's unpack that protection model, because this is really the story here.
Yeah.
If sales volume is just inching along, how do they generate such a decisive EPS beat?
Well, it all comes down to the membership fee income, the MFI.
So why is that specific line item the key lever right now?
It's the key lever because it is almost pure high-margin profit, and it's recurring revenue. It operates like a predictable annuity stream for the company.
Which insulates them.
It effectively insulates them from a lot of the commodity cost fluctuations that batter traditional retail margins. MFI is the high-octane fuel that allows the rest of the business to run.
And the numbers, they show that engine is roaring. Membership fee income grew an incredible 9.8% to $126.3 million this quarter. That's massive growth.
It is.
What were the specific drivers fueling that nearly double-digit growth?
There were really two main factors working together here. First, that fee increase they implemented back in January 2025.
Yeah.
It's clearly paid off. No discernible member backlash.
Yeah, second.
Second, they hit a record penetration rate for their higher tier memberships, improving that metric by 50 basis points just sequentially.
Okay, help us understand that. For the listener who might not track those retail metrics so closely, what does a 50 basis point improvement actually mean financially?
Right. It means a higher lifetime value for those customers. The higher tier memberships, sure, they come with a greater annual fee, but they also signal a deeply committed member.
Someone who shops more.
Shops more frequently, spends more per visit. By successfully migrating more of their base into those premium tiers, they're locking in higher predictable annualized revenue. And they expect that MFI growth rate to improve even further in Q4.
And they're still confident in renewals.
Crucially, yes. Management maintains confidence in delivering a 90% 10-year renewal rate for the full year.
So if that MFI growth is the financial rocket fuel, how did it translate into the margin discipline they needed to hit that EPS beat?
The MFI provides the resources they need to invest in price without compromising profitability. So merchandise gross margin, when you strip out the effects of gas, and MFI was flat year over year.
Which is impressive given the price competition.
Very impressive stability.
But the adjusted EBITDA earnings before interest, taxes, depreciation, and amortization, that was reported at $301.4 million, which is down 2.2% year over year. So why the drop in the core earnings metric?
Yeah, you have to strip out the noise there. Specifically, a one-time quirk from last year.
A legal settlement.
They realized a substantial legal settlement benefit in the prior year's Q3. So if we normalize the numbers, if we remove that one-off, non-operational cash infusion, the true underlying story is that adjusted EBITDA actually grew approximately 5% year over year.
And that distinction is vital. It shows that beneath the surface, the business is actually becoming more efficient, not less.
Exactly.
And that efficiency narrative brings us to one of the most proactive and, frankly, fascinating strategic decisions management made this quarter: inventory management. What was their explicit strategy with general merchandise inventory?
They were very transparent about this. Total inventory levels were deliberately cut down 1.5% year over year overall, and notably down 5% per club. They specifically admitted to proactively tightening general merchandise or GM inventory earlier in the year.
And the main driver for that caution was tariff uncertainty. So they made a calculated choice to limit their exposure to discretionary items, things like seasonal, home goods, to protect their downside margin risk.
It's a high-stakes trade-off. They are deliberately limiting the potential upside of the general merchandise business in the short term. They know they might miss some sales volume on those higher margin impulse items.
Oh, it protects them.
But that cautious approach achieves two things. One, it prevents disastrous markdowns if demand softens or if tariffs hit. And two, it frees up capital that they can then use to fund greater price investment in essentials. It reinforces the value message.
Okay, let me challenge that strategy for a second. If the MFI revenue is subsidizing the price investment and management is simultaneously throttling the general merchandise segment, which is usually where you make your margin in the holiday season, isn't that just robbing Peter to pay Paul? What happens when the MFI fee increase annualizes out? Is this sustainable long-term, or is it just a strategic dodge?
That is the core question facing investors. Management is betting that member loyalty outweighs the short-term sales hit. They are using the MFI stability as a bridge to fund their future growth strategy.
So they're playing the long game.
The very long game. If they can cement member loyalty now with low prices on consumables, they believe that member will stay and eventually purchase items digitally or at one of the many new clubs they're building. They're prioritizing tenure and market access over optimizing Q4 GM sales.
Let's go back to the comp breakdown, keeping that inventory constraint in mind. Total comparable club sales, ex-gas, grew only 1.8%. That number feels small, but management offered the 2-year stacked comp of 5.5% as evidence of stabilization.
Right.
What did the two main product divisions look like?
Both major divisions, so that's perishables and sundries, and then general merchandise and services, they grew comps by an identical 1.8%.
Which tells you?
It suggests the constraint on GM sales volumes was very real. It prevented that segment from delivering the higher growth that you would typically see from discretionary categories during this time of year.
Okay, now let's turn from managing the present challenges to funding the future. If MFI is the operational bedrock, where is the capital being deployed for massive growth? We need to talk about this aggressive strategic expansion and technology footprint.
This is where BJ's shows tremendous confidence. They are accelerating their network expansion, reaffirming plans to open 25 to 30 new clubs across fiscal 2025 and 2026.
That is a massive capital expenditure commitment.
Massive, and they're executing on it now. They expect to open 7 new clubs in Q4 alone, totaling 14 new clubs this year. That is the most aggressive physical footprint expansion they have undertaken in years.
The risk with that kind of aggressive expansion is always dilution, but the early returns on their new clubs, they suggest they might be onto something.
They are. The clubs opened in the 2025 class are performing 25% ahead of plan on membership counts.
Oh.
That tells you they are picking their markets very shrewdly, targeting areas where the warehouse club model is either underpenetrated or, underserved. We saw them announcing new markets for 2026, Mesquite, Texas, and Foley, Alabama. These are strategic flags planted in new high-growth territories.
So the physical footprint is one pillar, but the digital story is the other. And frankly, it's far more impressive on a growth basis.
Oh, absolutely.
Digitally enabled comp sales grew a phenomenal 30% year over year.
That velocity is incredible. It represents 61% growth on a 2-year stacked basis. The digital channel now approaches 17% of total sales, which is a major shift in consumer behavior.
And crucially, it's efficient.
The crucial efficiency point is that over 90% of those orders are fulfilled directly by the existing clubs. This leverages their current asset base and avoids the high costs of, dedicated off-site fulfillment centers.
And to make that in-club fulfillment model work, they're investing heavily in operational tech, specifically AI and robotics. Let's talk about the robot named Tally. This goes way beyond simple self-checkout.
Absolutely. The use of AI is twofold. First, member-facing, beta-launched AI shopping assistants and predictive lists to improve the customer experience.
Okay.
Second, operational. And that's where Tally comes in. Tally isn't just counting boxes, it's creating digital twins of the physical clubs.
A digital twin, what does that actually mean for operations?
It means they have a perfect digital map of the physical location. This constantly updated data feeds back into their fulfillment systems, generating highly efficient to-do lists for team members. But most significantly, this data is used to optimize the pick paths for Buy Online Pickup in Club, or BOPI, orders.
And the efficiency gained from optimizing that BOPIC pick path is what caught my eye.
It's a game changer. Management stated that this path optimization improves BOPIC efficiency by about 40%.
40%.
Just think about what a 40% efficiency gain translates to in a high-volume warehouse setting.
Yeah.
Fewer labor hours spent per order, faster fulfillment times. That translates directly into lower operating costs and better member satisfaction. Again, another strategic investment funded by that powerful MFI stream.
So let's turn back to the macro environment and the consumers walking through those doors. Investors pressed management hard during the Q&A about consumer health, especially with the competitive landscape and that softer comp number. What was management's read on the shopper?
Well, management acknowledged the pressure points that a lot of other discount retailers are seeing. They specifically cited difficulty for lower income members.
What did they point to?
They pointed to the disruptions from changes in the SNAP program and the government shutdown, which impacted spending late in Q3 and into early Q4.
Wait, so management says the consumer is resilient, but they also cite SNAP changes and the shutdown. Isn't that a contradiction? Are they just glossing over a genuine structural weakness in their core membership base?
It's a tension they have to manage. They maintain that if you remove that temporary noise, the shutdown disruption purchasing habits for their value-sensitive members remained stable and resilient quarter over quarter.
Oh.
But the more important point is that this value-seeking behavior is now observed across all cohorts. Everyone is exhibiting sensitivity, higher sensitivity to promotions, increasing adoption of private label purchases.
Which is great for their own brands.
A great sign for BJ's proprietary brands, yeah. And trading down, like skipping expensive cuts of beef for more economical ground beef. The value proposition is resonating broadly, even if people aren't buying big-ticket items.
And that strategic tension between cost control and sales growth was reflected perfectly in the guidance update. We saw some conflicting signals there.
Absolutely conflicting. The profitability confidence led management to raise the adjusted EPS guidance for the full year to $4.30 to $4.40.
So, strong conviction there.
Strong conviction in their cost discipline and that MFI revenue stream. However, at the same time, they narrowed their comparable sales guidance, now expecting growth of 2% to 3% ex-gas.
So they're formalizing the cautious outlook.
Exactly. It acknowledges that top-line growth will be incremental, not explosive.
So investors, naturally, they zeroed in on margin stability. If you're constantly investing in price to stabilize market share, how are your margins staying flat? Where are the offsets coming from other than the MFI?
Management detailed several key operational offsets. They pointed to greater efficiency in their distribution centers, likely helped by some of that new tech and the rapid growth of their retail media program.
Retail media is huge right now.
Still relatively small for them, but it's a very high margin revenue stream. And circling back to the beginning, carefully managing markdowns via their conservative inventory planning provided huge margin protection. They were explicit in their philosophy. They said they will always err on the side of value over short-term margin preservation.
Viewing price integrity as the essential ingredient for long-term member stickiness.
That's the core belief.
Okay, now let's step away from the measured analysis for a moment. This next segment is where we throw caution to the wind and embrace the narrative tension. We need to be crystal clear. This is not financial advice.
Not at all.
These are simply outrageous but plausible trade ideas based on the specific facts and tensions that were revealed in the earnings call.
Think of this as a high-risk, high-reward hedge fund pitch delivered with all the required disclaimers. The thesis we've identified is that BJ's is using its high-margin MFI growth to fund two major strategic weaknesses.
Price investment and inventory.
Price investment, which stabilizes market share, and a cautious inventory stance, which prevents markdowns. They are consciously choosing margin protection in general merchandise over sales velocity.
And this looks like an opportunity to bet against management's execution on their own self-imposed constraints.
The pitch is a short-term bearish option trade. Look, given management's explicit decision to curb GM inventory to shield margins, and their admission that categories like home and seasonal were already challenging, we should anticipate that they have created a structural revenue drag in Q4 GM sales.
The single most critical sales window of the year.
The most critical. So what are the mechanics of that bet?
Tell me.
We buy short-dated, out-of-the-money put options, specifically targeting the low end of the implied Q4 comp guidance range. The entire trade is predicated on this deliberate inventory tightrope walk, failing to generate enough holiday upside.
So if they just don't have enough stuff to sell.
If that cautious inventory planning over-restricts the sales funnel, and they simply don't have enough product when shoppers come looking, or if the low-income consumer pulls back harder than management anticipated, the stock's modest post-earnings reaction could reverse sharply.
Because the market's patience for top-line underperformance runs out.
It runs out very quickly when faced with a holiday sales miss.
So a bet on the intentional constraint being too restrictive, risky, aggressive, but entirely derived from the explicit internal trade-offs made in Q3.
Which brings us to our final synthesis. The Q3 print, it validated the membership-driven earnings model. MFI is up nearly 10%. They raised EPS guidance. Structurally, this is a financially sound, disciplined business.
But, and it's a big but, it amplified investor anxiety about that competitive same-store sales performance, which is still stuck at 1.8%. The company is relying on high-margin recurring revenue and fierce cost control to fund necessary price investments and fuel this massive future growth pipeline of 25 to 30 new clubs.
The question now is really one of trajectory versus patience. Management is making a calculated gamble. They're betting that its accelerating digital capabilities, that 30% comp growth, and the massive physical expansion pipeline will eventually provide the fuel needed to close the sales comp gap with its larger rivals.
So here's the provocative thought for you to mull over. BJ's is planting flags in high-potential, under-penetrated markets like Texas and Alabama. Will the sheer volume of new clubs and the efficiency of their technology ramp fast enough to deliver the explosive top-line growth investors crave? Or is BJ's destined to be seen as a phenomenal membership business that perpetually underperforms on same-store sales volume, remaining the perpetually efficient but slightly smaller third wheel in the warehouse club category?
We encourage you to review the full source material for yourself. Pay particular attention to how management justifies their cautious inventory decisions and the breakdown of that dual guidance update.
That's it for this deep dive. We'll catch you next time on Talk Tickers.